Look, it certainly tips it further that way. It really caps a week where a raft of Fed speakers came out and pushed back on that dovish interpretation the markets had at the last Fed meeting. So we're kind of back to where we were. Is it 50? Is it 75? And there's a lot of wood to chop before the September meeting. We'll get another payrolls print. We'll get a couple of inflation prints. So I think, the main story here from payrolls is it just kills off this nascent, Fed is going to be dovish sometime soon scenario. That's gone. The dollar's back up. We just think it's too early to start thinking about the peak in this tightening cycle and the top in the dollar. It'll come, just not quite yet.
To what degree then, Tim, does equity risk premium have to move higher then after payrolls? And to what degree do we revise perhaps dollar and yield assumptions higher as well?
Yeah, I think certainly the equity market got a bit of excitement in the past week or so with that lower discount rate. I mean, in fixed income markets, we care about all sectors across the curve. But, the equity market hones in on that 10-year yield. And obviously that's been under a bit of pressure, given the expectation there will be a recession, which we do think will happen, just not quite yet. I think with something like the equity market, it's going to be how earnings come in that's going to matter more. And, look, fair play, the S&P 500 reporting season's been fine so far. But there are some pretty meaningful cuts to forecasts going through. So I think for the equity market and risk in general, the focus is going to shift to how are earnings going as rate hikes begin to bite. I mean, remembering it hasn't been that long since the Fed actually started tightening. I think the earnings hit's going to come, and maybe the bond market's going to start taking a bit more of a lead from how equities trade in reaction to that softer earnings pulse in coming months.